لا تنسوا الاعجاب بالفيديو والاشتراك في القناة.
Welcome to Part 8 of our seminar, Understanding Financial Statements. In this video, you will see how the amounts on the balance sheet are used by bankers and other lenders. You will also learn that the notes to the financial statements may contain important information that is not reported on the face of the balance sheet. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Okay, we're going to go to the handout Balance Sheet 2. The balance sheet allows bankers and others to quickly determine how much a company has in working capital. Now, working capital is defined as current assets minus current liabilities. So, in that balance sheet that we just reviewed, the working capital would work out to be $330,423. And I got that by taking the amount of the total current assets, which was $463,823, and then subtracting the amount of the total current liabilities, $133,400. Okay? So working capital. Right? So your banker is going to say, does this company have any working capital? How much do they have before I talk about getting involved with their business? Okay, the next thing we have to mention is those same two things, current assets and current liabilities, are compared. And we have a thing called the current ratio. And what we do is we take the current assets, the total amount of current assets, and now we divide by the total amount of current liabilities. And using those same numbers, the current assets of 463,000 something, and we divide by the current liabilities of 133,000 something, we get a current ratio of 3.5. And sometimes we say our current ratio is 3.5 to 1. So either way would work. Yes?
Going back to the working capital definition, which is the total current assets minus the total current liabilities, isn't that the same as the stockholders' equity?
No. The question is, isn't the calculation of working capital the same as the calculation for stockholders' equity? And the answer is no. Stockholders' equity was total assets, current and long-term assets, minus total liabilities, current and long-term. That's for stockholders' equity. For working capital, I use the word total to emphasize it's all the current liabilities and current assets. So, okay, so going back to working capital, it's total current assets and total current liabilities. The working capital and the current ratio are only as good as the amounts contained within the current assets and current liabilities. So again, if your inventory is overstated, you're overstating your working capital. All right, the next thing I want to mention is a thing called financial leverage. And leverage means how much debt do I have as a proportion of the asset. So if I purchase a $10,000 asset and I use $10,000 of my own money, there's no debt involved, right? So $10,000 of cost, $10,000 of my money, no leverage. But I might like to acquire a bigger asset, but I only have $10,000. So if I take my $10,000 and borrow $40,000, I can now purchase a $50,000 asset, right? So now I'm leveraging, right? I'm able to control a $50,000 asset with only $10,000 of my money. And so debt is good to a degree, right? Because if those assets go up at a higher rate than the interest I'm paying, I'm going to come out very well. My $10,000 might mushroom very high. However, as we've seen in the real estate market in some states, a lot of debt, high leverage, doesn't work so well when the values of the assets drop. So that when the asset value drops, you still owe all that debt, and it may wipe out all of your money, right? So everything gets a little more multiplied when you have debt. So you want some debt because it's pretty prudent and wise from a business sense, because usually the interest isn't very much and it's income tax deductible. So we can rationalize debt, and in our own lives, we like to live in a nice house and we can't pay cash. So it's logical to have some debt, but if you have too much debt, it's risky. And the other thing that's going to happen, if you have too much debt and you go to your banker for a loan, the banker's going to say, gee, you already have this amount, and I'm not going to have much collateral because your assets are already pledged. So you're too leveraged. I can't make the loan. It's too risky because you owe too much already. Okay, the last thing I want to mention on this page 2 is that the notes to the financial statements include the notes that pertain to the balance sheet as well as the income statement. And so the notes to the financial statements have lots of information on our balance sheets, including leases that we've entered into for space. You know, we operate in a storefront and we sign a 10-year lease. That's an important piece of information for a banker or an investor. So leases are described in our footnotes, pension obligations, and some other things you might find there would be information about lawsuits. You know, if we don't owe the money on the lawsuit, but we might lose, the notes should have some information about that, because we have a full disclosure principle, remember? The other thing is you'll find the accounting policies listed in the notes. So if you're wondering, is the company using FIFO or LIFO, it'll tell you in the notes to the financial statements. And if you really want something relatively easy to read, but lengthy, you could go to a corporation that's publicly traded. You could go to their Securities and Exchange Commission Form 10K, and that will give you all kinds of information about the liabilities and risk and other things. So a very great tool, but you can only find it if the corporation is publicly traded. But a great way to learn about companies. Okay, we're going to move on to the next page then, the one that says Balance Sheet 3. And accounting principles require that companies issue comparative balance sheets. So a comparative means more than just 1 year of amounts. And if a company's stock was publicly traded, it's absolutely going to be that way. But other companies should do it as well. And the exhibit then that we show is the December 31st, 2010 amounts to the December 31st, 2009. So some of those questions that we had earlier, gee, did they add some equipment, we're going to be able to compare now if we had both balance sheets, right? We'll be able to see some of that. So indeed, this company did earn, I don't know if these numbers will tie in exactly to the earlier schedule, but looking just at this schedule, you can see at equipment, it went from $220,000 up to $250,000. So they added $30,000, but we still need to go to the statement of cash flow, because what if we got rid of an old piece of equipment that was on the books, and it was on the books for 20, and we bought a new one for 50? That's going to net to 30, isn't it? So you're not going to get all your answers again, even from the comparative. Got to get to that statement of cash flow. Okay, and then down below we can just go down the line and see at your convenience what happened. Notes payable went up, and etc. So you can see the change. Anyway, the point is having 2 years is much more helpful, and that's why the Security and Exchange Commission demands it be done, and both have to be audited as well. Okay, so if you want more on the balance sheet, again, accountingcoach.com has a whole section on balance sheet, and you can find an explanation, quizzes, Q&A, puzzles, all kinds of facts that you can read at your leisure. So our job tonight is to introduce you to this, give you the overview, and just keep reminding you, you can get a great amount of information free online.